Pankaj Pandey, good morning. How are we doing?
Nikunj.
Bulls are saying energy nahi hai. The thunder is not there. Markets are making an all-time high, but that's just optics. The underlying fabric of the market in last 8-10 days seems to be getting slightly weak.
So at 22,000 levels, obviously it's a psychological level. Some bit of a nervousness is very much, understandable. But our sense is that typically during month of say Feb and March, market usually sort of tends to correct, and from there on we see things panning out on a better direction. And our sense is that for month of March, probably 3-4% kind of an upside is very much on the cards. Overall, earnings season was quite okay according to us. So we don't see much of a risk to the double-digit earning growth what we have penciled in for next 2 years. And I think 25,000 target for Nifty remains intact. In fact, if you look at market cap wise, what we are also seeing is that while people talk that small caps are sort of quite pricey, but our sense is that with 26% kind of earning growth, I think you have ample opportunities across caps. Be it large caps, be it mid caps or small caps. So I think overall setup looks good to us. The only hitch is that people are still sort of questioning what kind of or the quantum of rate cuts we could get, especially from the US, because our rate cuts also probably will hinge upon the kind of a rate cut what US Fed will do. And which is why I think financials is still sort of soft and not really sort of contributing. And we should understand that financial is 1/3 of the Nifty. So that is really not contributing at this point in time. And despite that, we are at 22,000 plus kind of levels at lifetime highs. So I think we still have enough firepower to sort of take Nifty to much higher levels. And I think if election outcomes come on expected lines, then I think overall we'll not be surprised if 25,000 is very much likely on Nifty.
Okay, fair enough. Meantime, how are you reading into the ups and downs and the roller coaster ride really when it comes to Zee Entertainment and the Sony merger saga?
So very difficult to sort of comment on this talk because fundamentally we were expecting that the ad revenue growth should improve in the second half. It hasn't happened for this company and even for Sun TV. So that's a sort of a missing leg. And I think if there are questions on the balance sheet, then it is very difficult to sort of put a fundamental perspective. So I think it is best to sort of avoid this talk till the time clarity emerges. I think no point in sort of doing bottom fishing in this talk.
So Pankaj, tell us what are your buy and sell biases in the market right now? Any stock ideas or themes you're working with?
So it's a kind of a pretty mixed thing, but what we are sort of liking is the cement and the infra space. So we like the entire tier 2 cement as a pack, and be it Star Cement, be it Birla Corporation, or even something like Sagar Cement. What we are also liking, because see, in cement companies, the overall valuation gap between tier 1s and tier 2s is quite significant. And we have seen that it has been a secular improvement in the EBITDA per ton for most of the companies, and most of the companies are also sort of guiding for decent volume growth there. So that is one segment what we are also liking. Then in the infra side, we have sort of upgraded some of the companies like NCC to a target price of 275. I think infra space, the valuations are sort of okay at 15-16 times. You have visibility for 2-3 years in terms of double-digit growth with margins largely likely to remain intact. And I think they'll also sort of benefit from the fact that if we see an interest rate decline in the second half. So I think infra as a space plus cement as a space is looking good. And then we are still liking select PSUs and select stocks across large caps, mid caps, and small caps.
Right. Okay, Pankaj, stay with us. Lots more to talk about, but a lot of sectors and stocks which are going to be in focus. And sugar companies, It seems as the fair remunerative price has been now upped to by about 8% for the period of 2024-25. Let's try and understand how this is going to impact sugar companies. Sharad is here with that analysis.
Well, it's a move coming in from the central government, and importantly the sugar stocks would be in focus as the FRP, which is called the fair remunerative price, that has increased by 8%, coming in at roughly 340 rupees per quintal, and this is for the next season as well. And importantly, last year also the FRP was raised, but the amount was lesser. It was roughly 10 rupees per quintal. And importantly, the basic recovery rate, that remains unchanged at almost 10.25%. But what's the impact? Sentimentally, it's expected to be negative on the sugar stocks. But do remember, most of the sugar stocks actually guided by their MSPs also, which are coming in from the state level objectives. Also, this is a populist move that what analysts are stating just ahead of the elections. And do remember that the sugar season, the next one, starts in the month of October as well. So sentimentally kind of a negative news flow might be coming for the sugar sector, but overall the impact seems negligible currently. But remember, there are two sides of the coin for the sugar sector, and of course the first one is that the state-wise crushing data is the data which we looked at, that has been growing and there has been a significant improvement in the sugar production. But on the underside, because of the highest sugar production, what has happened is higher crushing is also there, and that could actually put a downward pressure on the sugar prices as well. So sugar industry itself is kind of having mixed signals currently going ahead into the elections.
Okay, mixed signals when it comes to the sugar space. Pankaj, have you looked at any of the stocks within the sugar sector?
So overall, when you look at most of the sugar stocks, they used to trade at some 5-6 multiples, and now most of them have sort of inched up to lower double-digit kind of a multiples. And that is largely the ethanol theme, which is being played out, where eventually we'll get to 20% blending. Now, when you sort of look at coal as a sector, that is offering interesting avenues to sort of participate going forward. One is, so for example, what we are liking is say Coal India. Now, while primary demand for that is thermal or the end usage, what we see in some of the other sectors. But when you sort of venture into coal gasification, wherein you manufacture synthetic gas, eventually you can sort of end up producing methanol, which also can be blended with petrol and diesel, and we have seen China sort of doing it quite successfully. And eventually, this so this is another sort of avenue which is sort of opening up for lowering the carbon emission. And mind you, Coal India offers a good dividend yield, plus the valuations are quite attractive for next 2-3 years. One could easily see a double-digit kind of a volume growth. They are already sort of doing well on the volume growth front. So I think Coal India looks a good play for reducing the carbon emission with valuations in sort of quite fine shape. We have a target price of 500 on Coal India.
Okay, fair enough.
Pankaj, just within cap goods, where is it that you see opportunity in light of what ABB has done?
So I think one obvious concern with some of these names, big names like Siemens and ABB, is that their valuations are quite high, but you really do not see much of a sell-off happens because nobody wants to sort of sell these companies. Because while we look at valuations for next 2 years, they look quite richly valued. But when you sort of look at next 5-7 years down the line, a lot of these companies really look attractive, but fundamentally it's very difficult to put a price to some of these names. But we like this entire space. L&T is where we have sort of upgraded our target price to 4,100. Then we also like some of the niche players, like say, for example, Action Construction Equipment, or even other companies in that space. So we are trying to sort of play through both large caps as well as mid caps. This entire capex as a theme. But overall, I think if we get any kind of a dip in some of these names, I think one should buy. But the perspective has to be more than 2 years.
And Pankaj, that's what we were wondering, where the next cue for the market is going to really come in from, at a time when much of the fundamentals, at least so far, with terms of earnings and important events, clearly are behind us now.
So I think one important parameter which we feel that can sort of change the complexion of the market is obviously the stance changed by RBI. So at this point of time, RBI is still maintaining a stance. I think if we get some softer data print in US and in subsequent policies, RBI also sort of changes their stance. Then I think the entire BFSI as a space can provide the necessary lift off to the market. I think that is one space which has really not been sort of participating much. And I think be it your private sector banks or PSUs are participating to some extent, and also the NBFCs as a segment. I think that is one segment which is yet not sort of meaningfully contributed to the overall levels to the tune of about 22,000 what we are seeing in Nifty. So I think change of stance by RBI probably triggered by some US data print or US Fed action. I think should sort of change the complexion.
Okay, that's the take coming in right now on the market and where the next set of triggers are going to come in from. Pankaj, good to have you on the show as always. We'll
Thank you
let
so
you
much.
go on that note.